we will invite Joe Rosenberg, or Joseph Rosenberg, from the Tax Policy Center. He's going to discuss tax expenditure reform, something that we've already heard a lot about, but we look forward to hearing more.
All right. Well, I want to thank John and George and the Baker Institute for organizing this paper and inviting me and my Tax Policy Center colleagues to present this paper. So obviously the topic is tax expenditure reform. It's very topical. I'm sure. It's sort of the lot of the discussion in Washington has sort of coalesced around tax expenditures as possible an avenue forward. For the uninitiated in the room, what are tax expenditures? One way to state them is that they're spending through the tax code. In Washington, sometimes they're called loopholes. Sometimes I think they're just anything that people don't like. They just call them tax expenditures. I want to try not to get too much or even much at all into the sort of more tricky and conceptual issues about how you define tax expenditures, how you measure tax expenditures. So, I mean, the concept of the tax expenditure, and I mean some of the canonical examples, I mean the idea of tax expenditures sort of being spending through the tax code is that in many ways, generally speaking, these things are sort of economically equivalent to direct spending programs. So you have the classic example where you sort of convert military spending into a weapons procurement tax credit or something like that. And as you go down the list of tax expenditures, there are things that sort of jump out immediately as things that look very much like government spending. And of course, if you're trying to measure what a tax expenditure is, there's the question of what you're measuring it relative to. So you need that reference tax system by which to measure it. So again, we could probably spend this hour and several more hours on those issues of defining tax expenditures and trying to measure them. Much ink has been spilt, much of it by people in this room. So we're going to sort of punt on that issue, and our sort of working definition of what a tax expenditure is and how you measure it is just basically whatever OMB says it is. Generally speaking, so there's the OMB definition, and essentially it's any deviation from the normal income tax in a sort of Haig-Simons sense. What's the motivation for the paper and for the focus on tax expenditures more broadly? One. There's a lot of them. So in the most recent OMB budget tables for the fiscal 2012 budget, 173 different tax expenditures listed in their tables. They're large. So you have 1.1 trillion number. That's a number repeated frequently in Washington. To give it context, it's 7.3% of GDP. So how big is that? Well, that's about half of tax revenues we currently collect, and probably something more like 40% of a more normal level of revenue. So the point was made earlier. I mean, some people argue that the proper budget treatment of tax expenditures is sort of think them as equivalently and at the same time spending programs and tax receipts. So basically, they at the same time they make our spending look smaller and our revenue look smaller. And in aggregate terms, there's a lot of them. The last motivation is, again, just sort of reading the political winds. This isn't quite a typo here. So raising revenue by limiting tax expenditures may be, the most viable of solutions. The negative, the negative adjoinder to that is none of these are probably politically feasible, at least yet, at least now. So the set of politically feasible reforms that raise revenue at the federal level is probably the null set, but if that ever opens up, tax expenditure reform may be what fills that in. Where are we going to go from here? So this is a very sort of practical paper. We wanted to look at how you could actually, in practice, go out and try to raise revenue by tackling tax expenditures. That's sort of what we like to do at Tax Policy Center. We love numbers, we love charts, so you're gonna get a lot of that. I'm going to proceed in sort of 3 steps. So the first thing I want to do is just sort of lay out the history of tax expenditures, and this in part is a result of, we had a fantastic intern this summer, Allison Rogers, who pawed through all the old Treasury tax expenditure reports and put them all together and classified them. So we just want to take a look at how tax expenditures have evolved over time. Then we want to look at the distribution of tax expenditures, who benefits, and from what types of provisions do they benefit. And then lastly, we'll explore a few options for how you might in practice go about reducing some of these tax expenditures and what the revenue and distributional implications of that would be. So this is a time series of the total value of tax expenditures as reported by OMB as a percent of GDP. So this is taking the tax expenditure list and just summing up all the individual pieces. I'll get back I'll get back in a minute to whether or not that's a sensible thing to do. What we did was we collected the data right before the Tax Reform Act of '86 to sort of give us a reference point, and then collected it going forward. So the sort of point is the Tax Reform Act of '86 did a fairly good job of reducing tax expenditures, as measured sort of in current terms. As a percent of GDP, total value of tax expenditures dropped by about 3 percentage points of GDP. There was some work right after the reform done by Tom Dybbuk and David Julfein, where they sort of controlled for the changing economic and trends in the tax expenditure, just looked at the effect of the change in the tax law, was a little bit larger, and I think they found about 40% of that change came from base broadening, with the remainder coming from the reduction in marginal tax rates. So I suppose I won't say too loudly that the easiest way to reduce tax expenditures is to lower marginal tax rates, but hopefully that isn't seen as a great option, at least to raise revenue. Since the Tax Reform Act of '86, now there's a lot of things going on here. There's legislative changes, there's technical changes, and there's sort of underlying economic changes that are moving this number around. The point is, this is sort of the, where we're ending up, the 7.3% of GDP number. It's large. Think of this as, the amount of revenue, additional revenue that, would be available under a comprehensive normal income system that we're not collecting. So of the 3 percentage points we gained in the '86 Act, we've given back about half of that. A quick breaking out the total amount of tax expenditures between business and personal. So here we take all the provisions that OMB classifies as corporate and add in some of the flow-through business tax expenditures. to get the business personal split. Obviously, overwhelmingly, these things are sort of fall under the personal type of tax expenditures, about 90%. We can also break out the value of tax expenditures by type of tax expenditure. So deferral versus exclusions versus deductions versus credits and special rates. And, again, there's sort of various things going on here that are driving each individual line. So you look at, deferral, that's largely the retirement accounts, the deferral of income that are in tax preferred retirement accounts. Obviously, the value going in has been increasing. Marginal rates have been changing, and also the value coming out has been increasing. So, exactly how you want to interpret this there's several things going on. A great thing would be is decompose this into the sort of economic, technical, and legislative changes. Obviously, that takes a little bit more work. Exclusions, that's largely the exclusion for employer-provided health, sort of secular trend increase in that. We saw that demonstrated or explained yesterday. We have deductions, that's largely itemized deductions. You have special rates, that's the primarily preferential rates on capital gains and dividends. The Tax Reform Act of '86 eliminated that differential. It opened back up. Obviously, in 2003, we added dividends to it. That it's projected to grow smaller because this goes out to 2016 under a current law baseline when the capital gains rate is projected to rise and the dividend and the special break for dividends is set to expire. The last piece is the credits, and there a lot of that is driven by legislative changes. So you had the legislative increase in the ITC, the institution and expansion of the child tax credit, and some more recent credits that some of which are temporary. So who benefits from tax expenditures? So this is where we go to the CPC's microsimulation model, and what we basically do is so I alluded to this notion of what the charts I showed you up until now have just been summing tax expenditures up across provision. But that ignores interactions between them. It also ignores the fact that when you pile on income, you move people into higher rates. So, whether you get more revenue than the sum of the individual pieces or less is a little unclear. We can try to do all that at once and do that in a sort of comprehensive microsimulation framework, and we do that. And that we can, our model can accommodate the vast majority of especially large individual tax expenditures. The ones that we do what are called off-model adjustments. So we take the Treasury estimate, adjust it for the change in marginal rates after we've added in all the tax expenditures that we can account for, and then attribute it based on where we think the incidence lies. So in 2011, what does that mean for the average household? About $6,600 in average tax savings. In other words, so the overall effective rate in 2011 across all households is about 18%. It's almost 10 percentage points of their pre-tax income, or a 10 percentage point, effectively a 10 percentage point reduction in the tax rates that they would face under this hypothetical tax system. I can make pie graphs. Here's a pie graph of the distribution by income group. Not surprisingly, given the distribution of the pre-tax income and the progressivity of the individual tax system, overwhelmingly the majority goes to high income. So 24% to the top 1%. That's more than the bottom 60% combined. About 2/3 of the benefits accrue to the top quintile, the top 20%. Now, again, that's not to say everybody doesn't receive benefits relative to their income. So here's the effect on effective tax rates. And so what you can see is larger effects up at the top of the income distribution, but still significant benefits across all income groups. Again, overall average of about 10 percentage points. So at the very bottom, a lot of that are elderly people, low-income elderly, whose Social Security benefits are largely excluded from tax. As you move into the second quintile, you get more of the EITC, child tax credit, and things like that. And then, of course, at the very top, you get the preferential rates on capital income, the exclusion for tax-exempt interest, and things like that. This again breaks the distribution by type of tax expenditures defined a little bit differently. And again, you see that different income groups benefit from different provisions. And this is just trying to quantify that. So capital gains, again, this is a one-year cross-section. Overwhelmingly, capital gains are received by the top 1%. So I think that's well over 50% of the tax expenditure benefit accrues to the top 1/10% of households. And as you move from capital gains and dividends to itemized deductions to exclusions, and you start to move down the income distribution. Of course, the non-refundable and refundable credits are what the bottom two groups benefit the most from. Okay, so reforming tax expenditures. How would we ideally want to do this? Well, we'd want to ideally do it probably like we'd want to ideally do any tax reform. We'd want to go provision by provision. Think about the policy justification for that provision. Think about the economic benefit, sort of the economic rationale and efficiency argument for the provision, and maybe consider the sort of administrative reasons. If it makes sense from a policy standpoint, does it make sense to run it through the tax system versus a direct spending program? That may be how we want to do things. That's probably not the way things are going to unfold. So the way I may frame it is we're going to sort of apply tax reform principles to tax expenditure reform. So tax reform principles being broad, have a broad base and a low rate. What we're going to try to do is take a broad class of tax expenditures and not try to eliminate any single one, but just take a part out of all of them. And they're large enough that gets us somewhere, and we don't face as much of the sort of political difficulties and economic difficulties of dealing with sort of the interest group issues and behavioral responses of tackling things provision by provision. Now, do we ultimately get to the best place? Maybe not. But that's the approach we're going to take in this paper. Let's define a set of tax expenditures, and let's think of ways in which we can reduce them and look at the effects. So the tax expenditures that we're going to look at, we're going to only look at 7 tax expenditures. So there's the 173, we picked 7. Although I think actually charitable deductions counts as 3 given the way it's reported. But there's 7 of the large ones. Now, because they're large, one of the reasons they're large is because they're widely used and enjoyed by people, which makes it difficult. But nonetheless, you look for money where the money is. So just to quickly run down what the provisions are: the exclusion for employer-provided health insurance, the major itemized deductions, the preferential rates on capital gains and dividends, and we threw in the child tax credit. So that's a little over $480 billion. So just these 7 tax expenditures represent nearly 44% of the overall total. So this is sort of illustrative. You can feel free to take in and take out. If you were doing this on your own, again, the sort of strategy that we think is maybe preferable is to take as large of a set as you think you can. And we're going to consider 3 options for reducing them. One is replacing them with a flat rate credit. So basically, you eliminate all the you repeal all the tax preferences, and then, yes, I realize you create a new tax expenditure, which is called the Tax Expenditure tax credit, which is equal to a flat rate based on the value of, in this case, the sum of the employer-provided health exclusion, the sum of your capital gains realizations and qualified dividends, the sum of your itemized deductions, and in this case, we're not including the child tax credit in this example because it's a little bit hard to think about how you sort of cap a fixed rate credit. You could essentially you could in theory convert it back to some equivalent deduction and then reduce it by the marginal rate. But for the purpose of this exercise, we just left it out. Now, the thing to note about this is we're essentially eliminating the upside down nature of many of these provisions. The fact that the benefit increases with the marginal rate of the taxpayer. The second option is to limit the value of the tax expenditures as some percent of your income. This may sound similar. It's similar to a proposal put forth by Marty Feldstein and Maya McGinnis. John and I didn't coordinate on our binge drinking metaphors, but this is sort of I describe it as the binge all you want until we cut you off. So you can enjoy tax expenditures up until you reach some limit, and then they're sort of immediately eliminated. The third option is the simplest option, which is you just take an across-the-board haircut to all the tax expenditures that you include. So you just you reduce all deductions and credits by some fixed percent. You include that percent of income for exclusions, and for preferential rates, what we basically did is just reduced the tax savings in the top bracket. So what we basically did was just raise the capital gains rate so that the tax savings in the top bracket was reduced by this constant percentage. So what are the options? We just decided to pick, for the first option was to use a 15% credit, right? So we're going to repeal all these tax expenditures and institute a 15% flat credit. We're going to calculate the tax savings in 2011 and then calibrate the other 2 options so that they have the same static effect overall on households, so we can get a fair comparison in our distributional analysis. Quickly, the revenue impact. Bottom line is right. So we just took 7 tax expenditures. We took 35% essentially of those tax expenditures. So we're taking about 15% of the tax expenditure budget, and you can see we're getting $2 to $3 trillion over 10 years. Now I won't go into exactly all the details of why they differ so much. A lot of that is the types of behavior that we assume, especially with respect to capital gains realization. So in particular, that's why the second option does much worse, because basically high income people hit their AGI limit, and all of a sudden their rate on realized gains goes to the top rate. And existing evidence says that capital gains realizations are pretty responsive to the marginal rate. How many people are affected by these proposals? So this is the percent of taxpayers that face a tax increase under these proposals. The limit option impacts the least, which means for the people that it does affect, it causes the largest tax increases. The other two are fairly similar in terms of pattern. Obviously, the credit insulates the bottom quintiles much better than the haircut option. How does it affect taxes paid? Again, sort of what you'd expect. The credit again sort of insulates. Certainly the lowest quintile, and it's generally progressive across the income distribution. The income limit is quite progressive, again, because a lot of what it does is eliminate the tax benefit of preferential capital income rates for extremely high incomes. So the top 1% really gets clobbered under that option. The haircut, the distribution's pretty similar to the overall distribution of overall tax expenditures. You're basically making everybody take a roughly proportional hit in related to how much they use tax expenditures. So let me go back. Let me go back to this chart of the difference in effective tax rates. How much did we get from the 15% credit option? Again, just about 15%. But remember, that was about $3 trillion over 10 years. So how big is that? That's about the size of CBO's current law deficit. And if you want to compare it to something that is maybe more reasonable, it's about 3/4 the cost of fully extending the 2001-2003 tax cuts and indexing the AMT. I don't really have time, but we did a couple variations where, again, I said we didn't want to get into what the appropriate baseline is, but we did do a simulation where we remove the preferential rates on capital gains and dividends from our definition of tax expenditures and run that. The one interesting thing to note is obviously the AGI limit turns from being extremely progressive to quite regressive. So just the last slide to sum up. How might something like this be used? One, it could be just used as a pure revenue raiser, so sort of like the 28% cap on itemized deductions and now other tax expenditures that the President has proposed and which has died for a fourth time, I think, today. Again, it could be used as a pay-for extending the tax cuts. In terms of helping our medium-term budget situation, not extending tax cuts that significantly exacerbate our deficit problem, or at least paying for them with other tax increases, would at least be a start. And lastly, to be part of a larger tax reform proposal that takes, probably broader, something like the Bowles-Simpson or the bipartisan poly, the Rivlin-Domenici group, take a large base of tax expenditures, reduce them in some form, and use that revenue to lower marginal rates and hopefully in part reduce the deficit.
Thank you, Jeff. Our first discussant will be Edward Kleinbard from the University of Southern California Gould Law School. And welcome.
Thank you, John. Thank you for the opportunity to talk to all of you, and thank you, Joe, for the paper. Well, this has been a very depressing conference by design. How can we not be depressed about the budget situation? This paper is the ray of hope. It points towards a solution to the practical aspects of our budget crisis that could actually be realized within our current political system. The president today, while we were here, held a press conference and reiterated his support for considering large-scale tax reform, including the elimination of substantially all tax expenditures, remember, which is an extraordinary thing for a Democratic president to put on the table. To paraphrase Larry Summers' old joke about the VAT, once Republicans understand that eliminating tax expenditures is a form of spending reduction, and Democrats understand that eliminating tax expenditures is a tax increase, well, then we're going to have tax reform. For that reason, the paper is extremely important because these fellows have the good fortune to have a microsimulation model where they can actually give us useful numbers. Just remind everybody that the United States is an outlier. We are a tax expenditure junkie. Canada is the only other country in our league. And that relates to some sort of special issues, constitutional, and how they run their retirement programs. Henry mentioned earlier that, VATs have tax expenditures also. That's true. But just to remind you, the numbers that Joe's presented were all just income tax numbers. The payroll tax expenditure attributable to employer-sponsored insurance by itself is another $100 billion a year, and that's not in any of the numbers. So that's a $1 trillion issue right there, or actually a little bit more. Tax expenditures also are tricky. They each serve different purposes. EITC is not an enhanced investment tax credit. We have income support expenditures, social spending, capital formation. They're all pointing in completely different directions. And they vary very substantially in size, as we've already seen. The home mortgage interest deduction, $485 billion over 5 years. The child credit, 121. The child care credit, 13. And some of them replace explicit expenditure programs. So the EITC would be a good example of that. It's therefore, to my way of thinking, when one looks at historical comparisons of growth in tax expenditures, you have to sometimes ask, is this a one-for-one substitute for what previously had been on the explicit expenditure side of the budget? As Joe's pointed out, tax expenditures are sensitive to other tax specifications. Tax expenditures as a percentage of GDP would have gone up more in the 2000s had we not cut rates. And I'm going to talk a little bit about the standard deduction. And some tax expenditures are argued to be just tax rate specifications. So, for example, capital gains and dividends, there are many people who would say those aren't tax expenditures at all. They're just specifications of rates on capital income. If we, in fact, adopted a Norwegian-style dual income tax, we'd have a uniform low rate on capital income, and we wouldn't consider those tax expenditures at all. So when I come to the paper, one of the concerns that I have with the paper, which is very, very helpful, the paper, is, are we comparing apples to apples? We're combining sort of a hodgepodge of different kinds of tax expenditures, for capital income, for income support, and for social engineering, and taking sort of one from every column and putting them up. To me, the paper would be more robust if we had a a rationale, a reasoning. Why did we pick these expenditures? What's the theory that links them behind them? And it's therefore it gets a little bit confusing when you want to say, well, I don't agree with putting capital expenditures on the table. Well, it becomes difficult to tease that out as compared to other expenditures once they're all mushed together in the three cases that are studied. So the case studies are these somewhat arbitrary combinations. And one question is why this particular combination. Another is, what is the overall objective? What's the target here? Are we trying to raise X dollars? How are we going to use the dollars we raise? In turn, that will affect at least a full-on macro model would be affected by how we use the dollars that we raise. And there are distributional consequences, of course, if we take these the number of dollars we raise and we use them for different purposes, in turn has very significant distributional differences. Alternatively, are we just trying to increase progressivity, or is there some other distributional goal? If we in fact want to increase progressivity, then why are we picking on the poor child credit, which is a credit really for the lower income Americans? If we're trying to improve economic efficiency, well then why are we picking on capital income expenditures? So it's the paper would be better if we had a little bit of a conceptual framework. The paper assumes a number of behavioral responses to scalebacks of the various tax expenditures. Hopefully the paper can be expanded to back up some of the claims. The way I read the paper, for example, it presupposes a dollar-for-dollar cutback in charitable contributions to reflect the lower tax value of charitable contributions if itemized deductions are limited. I think we would all agree that there is going to be a scale back, but I'm not sure that it's dollar for dollar. That's not my recollection of the literature, and so on. And when you come to behavioral responses, oddly enough, the standard deduction has all sorts of weirdness associated with it that we might want to just notice for a minute. The first is this idea of tax form behavior, which the paper assumes. The paper assumes that taxpayers will flip into or out of the standard deduction based on whichever optimizes their tax bill. And that kind of operates in a sense as you could view it as sort of a floor on itemized deductions. If you imagine that the code was written as you're entitled to itemized deductions of the following sorts, but in no event less than X dollars, we would say what we've got is a floor on itemized deductions, and in effect that's how the standard deduction works. So if we're going to put things like itemized deductions on the table, why not also the standard deduction? Why not consider it like a 15% credit or something? Because right now we give the benefit at the 35% rate to higher income Americans. It's also, I think, would be very helpful if the paper were to more directly note how the standard deduction complicates the adjusted gross income cap idea, the Feldstein-McGinnis proposal. For example, the way it would work is you would calculate all of your tax expenditures, you would compare that to your cap of AGI, then you'd say, geez, I'm not getting any benefit from all of these itemized deductions, so I'll kick them out and I'll take the standard deduction. So now I'm done. I know what my haircut is. But no, then you're not done. Then you have to take the remaining tax expenditures like employer-sponsored insurance and go back and do it again. And then we get all done with that, you have to do the AMT. So the AGI, the Feldstein-McGinnis proposal has a large number of technical defects that this paper, I frankly think, could usefully point out in its discussion of what, after all, is their idea, just with different tax expenditures chosen. Finally, as long as you're going to choose arbitrary groups of tax expenditures, why not choose the most important group, which is itemized deductions? They are special, and they're special in a bad way. First of all, they're the big money. Employer-sponsored insurance is the only one that's bigger. The personal itemized deductions as a group dwarf that and are by far as a group, sort of the largest cluster. They're regressive, they're expensive, they're distortionary, they're inefficient. I mean, they are, the trifecta of sort of public finance sins. And why not just take them as a cluster and run that as a case? And it is, in my view anyway, the way that we can, as a practical matter, raise revenues efficiently and equitability. Here are the numbers. Over 5 years, you could just total it up, and you're at $1.2 trillion for the major personal itemized deductions. And my joke is they may be political sacred cows, but it's come down to either the cows survive or they stampede us. And, we all have to decide. In fact, Joe was kind enough to do some numbers that show that from a year or so ago, that the itemized deductions alone, we're talking about 1.5% of GDP. Well, the fact is that if we let the 2001-2003 cuts all expire, and we pick up another 1.5% of GDP by getting rid of personal itemized deductions, we're done. We've declared victory. We win. We, in fact, have got to budget surplus in 10 years. And as Joe's already pointed out, they're highly regressive. And so my concluding thoughts are simply, first, whatever we do, we need to boil the frogs slowly. You can't get from here to there overnight, and maybe the paper can talk a little bit about transition issues as the authors see it. And finally, tax expenditure process reform is critical, not as a way of getting to a substantively different place, but as a way of preserving the deal for whatever that substantive place might be. Thanks very much.
Thank you very much. It was excellent. Our next discussant is Tom Dybbuk, Dr. Tom Dybbuk from Ernst Young.
Well, thanks, John, and thanks, George and the Baker Institute for holding this conference. I guess I don't find this conference depressing at all because hopefully we're moving partway toward a good solution because, oftentimes recognition of the problem is 50%. And clearly, a lot of people are in denial. And so this type of discussion at least moves us part of the way there. I think this paper by Joe and his colleagues is also going to be very helpful in the discussion that tax expenditures clearly are a big issue. And if you look at some of the recent legislation in 2010, Congress and the policymakers have recognized that the current use of the tax system to encourage certain desirable public policy things like alternative fuels credits, tax expenditures don't work. And so that in several cases they actually put in the law that you could take a tax expenditure, a alternative fuels credit, or you could get a cash grant from the Department of Energy. That clearly shows the fact that there is substitution of tax expenditures for cash grants, which is what Stanley Surrey back in the late 1960s was showing why tax expenditures really are spending through the tax code. I guess I am concerned about a number of the commissions falling back on just straight across the board repeal of tax expenditures. And this paper essentially also only looks at tax expenditures. I liken this a little bit to the drunk looking under the lamppost, the nearest lamppost for his keys, because it's readily available in terms of the light, but misses an awful lot of other things that we could be doing in the tax system. We did a study recently, earlier this year, that looked at the 1986 Tax Reform Act. 40% of the base broadeners were non-tax expenditures. If you look at the President's fiscal year 12 budget proposals, 60% of his tax budget proposals were non-tax expenditures. My sense is the tax staffs at Treasury, on the commissions, at the JCT, really haven't gone into the tax code and identified a number of other possible base broadeners. I notice Jane Gravel's paper that's coming up does raise a number of additional ones. But when people say that we can only get the corporate tax rate down to 28%, if you repeal all tax expenditures and they stop there, I think we can definitely get the corporate tax rate down to 25% or even lower if we were really making sure that we were moving toward a broad economic tax base. But clearly, politically, this might be the viable approach, and this paper does provide some very important insights in terms of 3 alternative ways of trying to take a broad brush approach to it. Joe mentioned that really the preferable way would be to go in and look at each of the individual tax expenditures and evaluate them on a cost-benefit basis, including administrative costs. It's interesting that the House legislation in 2010 that extended expiring provisions was passed 3 times by the House. It had a provision in it that the Joint Committee on Taxation would do a very detailed analysis of all the expiring tax expenditures, but that was not included in the final legislation. The one interesting twist to that particular House legislation was that they were mandated to look at the smallest tax expenditures first, so that they would not get to mortgage interest or pensions or others until 2200 or something like that. But anyway, the backdoor approach is not the desirable way in terms of prioritizing. It just goes after all of them, sort of like the alternative minimum tax. And again, if that's the way we're going to make policy in the U.S., that's unfortunate. I do think the paper would benefit from having some more analysis of the 3 alternative approaches that are being analyzed. For instance, the 4% of AGI cap has economic effects that would be important to point out. As you said, you binge until you get cut off. Well, that essentially eliminates all of the marginal incentive effect for any additional charitable deductions. And although I'm not a big believer in this inframarginal effect, but if people think that we should try to eliminate inframarginal subsidies, this 4% of AGI approach is essentially just giving an inframarginal benefit. In the case of the 15% credit, that is an attempt to rationalize the government spending through the tax code instead of the upside-down subsidy, having a flat rate subsidy for all people borrowing money to own owner-occupied and second homes, and a similar amount for people doing charitable contributions. It is interesting that the proposal that was analyzed does not allow refundable credits. And if you are going to rationalize a government subsidy, again, one of the reasons why tax expenditures are bad, because you oftentimes don't allow a cash grant to be fully refundable. And so I would think if we're going to do that, we should try to allow those tax credits that we want to have in the future to be refundable. In terms of the comparisons are very useful, looking at the different revenue and distributional effects. I would agree with Ed to some extent. They're apples and apples. 2 out of the 3 include the child credit. The other one does not, and so you're not able to do the specific comparisons. It's also interesting that the choice that you're not including the earned income tax credit, you're not including all the deferral items. And one of the issues in terms of thinking about tax expenditures, and another alternative is to try to design a system where tax expenditures would be subject to the same type of sequestration that the discretionary spending and defense spending would be subject to. And it's we need more thinking in terms of how limitations would be placed on deferral items. You have a chart that shows that deferral items, this includes the pension and the 401ks, accelerated depreciation, account for about a quarter of all tax expenditures. And I think more thought needs to be given in terms of how you do a limitation on the value or impose sequestration on deferral items. So I think there are an awful lot of numbers. In fact, I think there are probably too many numbers. A good summary table would be very helpful. And I think in some cases, less is more. So I don't think you need to have all the different scenarios, even though Ed would like to have more done. That could be a second or third paper. But I think, unfortunately, we probably are. And if tax reform is time constrained, we are not going to do the type of real detailed analysis of other base broadening beyond tax expenditures. We're not going to go in and really prioritize public policy in terms of choice of tax expenditures, those that we should keep and those that we shouldn't. And instead, we're going to do things like another AMT on itemized deductions. But there we should at least know what the distributional revenue effects are.
So I want to let Joe respond, but we actually are somewhat on time this time. So let's take a few questions, and then we'll invite Joe up to respond, or Joe can answer some questions. Let's come on up. And are there any questions? Any discussion, comment? Henry?
Yeah, it's really a comment on Ed's opening, which embodied what I think is at least an embryonic optimism about the prospect that Republicans and Democrats might recognize the virtues in repealing tax expenditures. I really don't share that optimism, and I would phrase it in the same framework that Ed did. It seems to me that the difference between, if you will, conservatives and liberals, or the contemporary word progressives, on the issue of tax expenditures is that both are willing to entertain the rollback of some or most of these, but for entirely different reasons. For conservatives, it's a means of financing rate reductions. And that was expressed in Alan Simpson's number, which was 1.1 trillion of tax expenditure reductions, of which 100 billion would go for deficit reduction. There's the 10-to-1, or even better than 9-to-1 agreement expressed that the conservatives turned down because it wasn't enough in the direction of it entertained any revenue increases. In contrast, liberals or progressives view the revenues from tax expenditures specifically as a means for deficit reduction without as many, or if possible, in some cases, any spending cuts on the direct expenditure side. So I think there is a very, very sharp disagreement between the two sides, to say nothing of the political opposition from each of the groups that benefits from particular tax expenditures, which all in all makes me very pessimistic about the prospects of achieving much in this area.
Can I give one sentence response?
Yeah, sure.
So the difference, Henry, between you and me is only this, that you see the glass is 9/10 empty, and I see it as 1/10 full. I agree, of course. I agree absolutely with what you said. I agree that they're using it for completely different purposes. But once you're in the room and negotiating from a common framework of tax expenditures are on the table, that's where we're going to get the revenue rather than very large increases in marginal rates. And we are, in fact, going to increase the revenue base, at least for a moment in time. Now, once you're in that kind of environment, there is at least, a small prospect of people coming to a compromise of views. In the absence of compromise, well, then, of course, the everything you say is right.
From your mouth to God's ears.
Yes.
Well, actually, two comments related actually to the discussants, but I think they're worth thinking about. First, I agree with Tom Dybbuk. We need to be a little more careful in thinking about what we want to do. So I would say with the itemized deductions, caps for the bad things, floors for the good things. And there are proposals to put an itemized to a percentage of income floor on charitable contributions, which would preserve most of the marginal effect. And then with respect to Ed's comment about the standard deduction, my recollection is that was all put together, the standard deduction and the personal exemptions, to exempt the poverty level.
That's
from
right.
Income tax.
That's right. The first
so
24,000.
The standard deduction is a little more than just a minimum. A minimum itemized for the itemized deduction. It was designed as part of like a zero rate structure, basically. So, but I don't see any point in going after the standard deduction. I mean, I think that's just hopeless.
No, but Jane, that's not. I apologize. That's not what I meant to say. What I meant to say was that you would turn it. In fact, let's say that the bottom rate is 15%. You turn it into a 15% credit.
You could make it into a credit.
That's what I said. So that's what you're doing there is you're preserving 100% of the benefit for the people for whom it's really intended, and taking away the 35% benefit for those with higher incomes. So that was my point.
Just to maybe enforce Harry's point, I just want to say that the Baker Institute may not support eliminating the charitable gain. Sure. I'm sure about that. It's not talking. I'm just saying they may not support it.
How about the oil and gas expenditures?
The pessimism's already fading away here. So I mean, Ed made a lot of great points. Payroll tax expenditures. Tom mentioned that too. But we've already started picking and choosing. So I mean, if you start from the point where you know which tax expenditures are good and which tax expenditures are bad, that's the sort of idealized situation. There's no question that it would be preferable to go provision by provision and put a floor under charitable contributions, maybe eliminate other things altogether. But I mean, at that point, now you're doing the sort of provision by provision, picking and choosing, doing the full analysis. The question is there a sort of shorthand? Now, maybe these options aren't better than doing nothing, but I'll say that. Most of your other points are taken well. Behavioral response to charitable deduction, that was a sloppy way of saying elasticity of one, of giving with respect to the tax price. It's not crazy in terms of existing evidence on the charitable deduction. Well, we invited you to our event tomorrow, but you didn't come. And Tom, more good points. This is, again, we started from the tax expenditure list. That's what politicians do, and I think fortunately and unfortunately. I mean, the nice thing about having a list is that it provides information. The downside is that it creates a box that people tend to stick to. A lot of your other points as well. The AGI limit sort of alluded to that, but yeah, you get these very large marginal, goofy marginal things. You also, I mean, essentially, it actually changes the marginal rate. Just overall too. I mean, as you increase income, you increase your tax expenditure limit. If you have tax expenditures to use, it's essentially a reduction in the marginal rate. But I'll stop.
All right, so we have a 15-minute break. If we could all just make sure to be in here by 2:58. Jane will start at 3, and we'll have 2 minutes of additional activities before then.